Ladies and gentlemen, good morning and welcome to the Zensar Technologies Q1 FY23 earnings conference call hosted by HDFC Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amit Chandra from HDFC Securities. Thank you and over to you, sir.
Yeah. Good morning, everyone. On behalf of HDFC Securities, I welcome you all to the Zensar Q1 FY23 earnings call. We have with us today Mr. Ajay Baturia, CEO and MD of Zensar Technologies, Mr. Sachin Zute, CFO, and few other members from the senior management team. Before I hand over the call to Ajay, I would like to highlight that the safe harbor statement is on the second slide of the analyst presentation and is assumed to be read and understood. With this, I hand over the call to Ajay. Thank you, and over to you, Ajay.
Thank you, Amit. Good morning, good afternoon, and good evening, everyone. Thank you for taking time to join us today to discuss Zensar's financial results for the first quarter of FY23. With me on this call are a few others from the Zensar leadership team. I have Sachin Zute, our Chief Financial Officer, Pramila Kalive, our Chief Operating Officer, Vivek Ranjan, Chief Human Relations Officer, Nachiketa Mitra, Global Head of Banking, Financial Services and Insurance, Arjun Varsi, Head of Corporate Development, Ankush Akar, Global Finance Controller. I am pleased to report that we are starting FY23 with revenues of $155.9 million, representing quarterly year-on-year growth of 26.3% in constant currency and 22.6% in reported currency. This growth translates into a sequential Q-on-Q growth of 3.1% in constant currency and 1.7% in reported currency, making it our highest ever quarter and 5 consecutive quarters of growth. Let me walk you through the performance of our geographies and verticals for the quarter. All the growth numbers are in constant currency. The US region registered quarterly year-on-year growth of 23.8% and sequential Q-on-Q growth of 2.5%, mainly driven by growth in the BFSI vertical. The Europe region registered quarterly YOY growth of 39.8% and a sequential Q-on-Q growth of 3.5%, driven by growth across verticals and service lines. We continue to have good traction in the region from both long-standing and new clients. South Africa region witnessed a rebound in its performance this quarter with quarterly YOY growth of 21.1% and a sequential QOQ growth of 6%. This growth was driven by new deals across banking and financial services and in cloud and advanced engineering. Moving to our verticals, we saw continued momentum in BFSI with quarterly year-on-year growth of 56.1% and a sequential quarter-on-quarter growth of 8.1%. We are witnessing consistent growth in this vertical over the last few quarters, aided by consistent addition of new clients and new deals and scaling up of some of our top existing clients. The HTM vertical saw slightly muted growth this quarter with quarterly year-on-year growth of 3.8% and a sequential quarter-on-quarter growth of 0.5%. While we have witnessed somewhat of a slowdown in the vertical, we continue to make investments to drive growth in this industry segment. Our consumer services vertical registered a quarterly year-on-year growth of 24.4% and a sequential quarter-on-quarter decline of 0.4%. We are seeing some reduction in discretionary spend in this sector, but we expect growth from newly opened relationships to offset some of the headwinds. Our gross margin stood at 26.6% in Q1 FY23, representing a sequential QoQ decline of 360 basis points. Our EBITDA margin stood at 11.2%, a sequential quarter-on-quarter decline of 290 basis points. We ended the year with a net cash position, we ended the quarter with a net cash position of $163.5 million. The order book for Q1 FY23 stood at $125 million, supported by multiple wins across verticals. The order book has a healthy mix of new wins and renewals. We have also scaled 2 additional clients to the $10 million plus category, bringing the total number of clients in this category to 13. For the first quarter, our last 12-month attrition stood at 28.1%. Attrition continues to be at an elevated level, and we expect the situation to gradually stabilize over the next few quarters. We revamped our fresher program in FY22 and remain focused on their training and fast deployment. Effective July 1st, we will be giving one of the biggest hikes in the recent past, making it to 2 consecutive years of high wage hikes. We continue to invest in associate learning and have expanded the scope of our continuous training programs, thus allowing for our associates to upskill and train themselves for high demand skills. Our service lines continue to deliver targeted solutions to our clients. Our big bets in service lines continue to reward us positively. We see growth momentum in advanced engineering, data engineering, and platform services. As always, I'm excited to speak about the work we do for our clients. We continue to deliver value to our clients through integrated solutions encompassing multiple capabilities and service lines. Let me take a couple of minutes to share some examples of high impact work that we have done for our clients. We are helping, for example, to optimize warehouse operations in real time for a US retailer by implementing integrated automation for its warehouse execution system. Another example, we are providing engineering services and end-to-end support for platform services to a multi-stakeholder nonprofit organization for internet governance. We have been selected by a large South African bank to modernize and migrate its mission-critical core banking platform to cloud to support the environment as a managed service. We have been selected by a leading global medical device company to design and implement a service model to support their technology and business transformation, while also providing end-to-end IT services, infrastructure, and application support. We have been selected by a leading payments card manufacturing firm to be its key systems integrator and strategic partner for high-velocity enterprise transformation through cloud engineering and DevOps. We have been selected by a leading mobility services firm to be its strategic partner in building a business-wide enterprise cloud data platform that integrates 7 lines of businesses and enterprise and client applications. We also won a multi-year managed services deal to provide end-to-end application support for the same client. We have been working with a leading infrastructure service provider for application development and support for its core applications, including their mobile app. We have partnered with a leading multi-brand insurance company in the UK to support a variety of technology transformation initiatives, extending across digital engineering on legacy technology stacks, building our new product lines, and enabling the group's innovation agenda. We have been selected and engaged as the SAP partner for a leading pharmaceutical company for its SAP Enterprise Application Management support. We are extending our support to a large UK-based P&C insurance company to optimize and automate its existing end-to-end application lifecycle management by the addition and setup of tooling, processes, and new ways of working with improved developer efficiencies. We continue to progress along our sustainability journey in line with our published ESG vision and mission. A sustainability and CSR committee was formed at board level to govern sustainability charter and provide guidance for our ESG initiatives. We successfully published our second integrated annual report that captured the economic value that Zensar has created with sustainability at the core of its operations. We launched our theme of #OnlyOneEarth on World Environment Day and formed a dedicated community of sustainability champions to execute Zensar's sustainability charter. We continue to emphasize Zensar's fundamental belief of being a responsible corporate citizen towards the environment by focusing on arresting carbon emissions, water conservation, effective waste management, and by participating in community initiatives. We saw growth across our key portfolios and geographies. Despite evolving macroeconomic uncertainties, we currently see pockets of softness in business. Some of our clients have indicated a reduction in spend amid the uncertain economic climate. We are keeping close watch on the economic environment and continue to stay close to our clients so as to respond to their needs and accordingly adapt our investment plans. To reiterate what I said in the last earnings call, we continue to focus on execution to drive resilience in our business. The areas in which we have invested, such as engineering, data, and platforms, are bearing fruit and have gained traction. Our strategic focus has resulted in an improved mix across the company in terms of client spread, vertical spread, and service line spread. As a result, we are now confident about our long-term growth regardless of short-term uncertainties. With that, I will now invite Sachin Zute, our Chief Financial Officer, to provide an update on critical financial data, after which we will open the floor for questions.
I'm sorry to inform, sir, but Mr. Sachin is not available in this conference, as I had been informed.
So Sachin and I are sitting together.
Okay, yeah. Thank you, sir. Thank you for the information.
Yeah. Thank you, Ajay. Good day, everyone. Welcome to the call. In addition to Ajay talking about the business, I'll take you through key financial metrics. In constant currency, growth for Q1 for FY23 was 3.1 sequentially and 26.3% year-on-year. In dollar terms, the reported revenue was $159.9 million for the quarter, reflecting growth of 1.7% sequentially and 22.6% year-on-year. The US dollar realization during the quarter has been rupees 77.1 per dollar against rupees 75.20 in previous quarter. Our gross margin stood at 26.6% in the quarter, a decline of 360 basis points from the previous quarter. This decline was primarily driven by higher cost of delivery, having negative impact of 2.5%, volume and utilization negative impact of 1%, and exchange rate impact of negative 0.1%. Our PAT reflects removal of one-time favorable items in other income of the previous year. Before we proceed further, I want to highlight that higher cost of delivery includes the following two aspects. One, continued supply side tightness, and record intake of freshers we had done in last few quarters who are undergoing their training and awaiting deployment. As freshers continue to get deployed in next few quarters, we believe it will provide us margin improvement levers and partially offset some of the headwinds such as salary hikes, which we have provided effectively July, as Ajay mentioned earlier. We continue to invest in growth, both through hiring of fresher talent, working through retaining our high-performing associates. This places us on a better footing forward, achieving our long-term predictable growth aspiration. Further, we continue to focus on various cost optimization measures, including fresher deployment, improving utilization, driving favorable commercial terms, optimizing pyramid, and improving shore mix. The effective tax rate has decreased to 26.3% in the quarter against 27% in the previous quarter. For the quarter ended June 30th, 2022, DSO decreased by 7 days when compared with the previous quarter. It stood at 83 days against 90 days, improving our cash conversion metrics. Our balance sheet continues to be strong and debt-free. Cash and cash equivalents, including investments in mutual funds, increased from 155.7 million at the end of previous quarter to 163.5 million at the end of Q1 FY23, an increase of $7.8 million. The amount of outstanding hedges as on June 30th, 2022 was equivalent to 154.2 million against 137.7 million at the end of previous quarter. The last item before I end my presentation, we have reclassified few of our accounts to reflect to better reflect our current industry verticals. Though the impact is not material, we have restated the data for last few quarters along with FY21 and FY22 is provided in the fact sheet. With that, I come to end of my presentation and open the house for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Manik Taneja from JM Financial. Please go ahead.
Yes, thank you for the opportunity. I hope I'm audible.
I'm sorry, Mr. Taneja, we are not able to hear you properly.
Hi, good morning. I hope I'm audible.
Yes, please proceed.
Yeah. I thank you for the opportunity, Sachin and Ajay. Just wanted to pick your brains around the way our margins have performed over the last few quarters and the way forward. So you to mid-teens EBITDA margins during FY23.
I'm sorry, Mr. Taneja. We missed some words. Could you please repeat your question, please?
Sure, I'll do that. I hope this is much better now.
Please proceed.
Yeah. So my question was for Ajay and Sachin. So our aspiration was to get to mid-teens EBITDA margin for FY23. And given the way our margins have progressed over the course of last few quarters and the fact that wage increments are yet to come through in the second quarter, how should we be thinking about that aspiration for FY23, as well as if you could help us understand the likely impact of wage increments in 2Q and the other offsetting factors that you expect to take into account for the second quarter. Thank you.
Yeah, thanks, Manik. First of all, hi, good morning, and I'll take a shot and then I'll request Sachin to add. So, Manik, what has played out during this last quarter, that is Q1 FY22 to 23, is extension of the issues and topics that have been the cause of decline in the previous quarters as well, namely attrition, driving increased salary interventions, an extremely inelastic labor market that continues to persist, driving up cost of recruitment, increase in spend on subcontractors, etc., etc. And then slightly up because we also, have substantially expanded our fresher program. And our long-term last 12-month attrition, as you just heard, stands at 28.1%. Now, what we realize is that because of this, and of course, we are laser focused on implementing margin improvement measures, and there's a bunch of them. What we feel now, specifically to answer your question, what we feel is going to happen in course of the next few quarters is that while we were attempting to get back to mid-teens end of financial year 23, we believe that that is going to get pushed out by 2 quarters. So getting to mid-teens will be around second quarter of FY24. That's the first question. To answer your second question, yes, we've got wage hikes, and we've given very material wage hikes, one of the best in recent years. We have done internal modeling, and the impact of wage hikes will be in similar range as what we had last year. Manik, does that answer your questions?
Thanks, Ajay. Just trying to prod you a little bit on some of the margin pressures that you spoke about. Some of these have been associated with the industry over the last 12 months, and given the way we reported in May, so I would say some of these factors were not new. So what surprised you relative to some of these trends playing out over the last 12 months?
Right. So Manik, we had a slightly positive trend towards attrition the previous quarter, and this quarter we saw attrition somewhat bounce back, and the resulting impact of that is, higher cost of interventions that we had to do to retain our people, higher cost of recruitment of talent to backfill the attrition as well as to, support growth. Our subcontractor spend went up. These were areas which turned out to be higher than what we had initially anticipated.
Sure. Thank you, and all the best for the future.
Thank you.
Thanks, Manik.
The next question is from the line of Sandeep Agarwal from Edelweiss. Please go ahead.
Yeah, hi. Good morning, Ajay, and thanks for giving me an opportunity to ask a question. Ajay, while you explained that our margin journey has been postponed by 2 quarters, but if you leave that aside also, right, even our growth is not super normal. So why I'm asking this is that if you see 3 years back when one of the large Indian IT companies got a new CEO, he came and he upfront said that I will invest 200 to 300 basis points in my sales and marketing engine, and we will first fix the growth problem and then we will look at the margin problem, because growth gives us the additional leverage to scale up, to bring in efficiencies and all those things. And exactly that way it got delivered. In fact, revenue growth was visible in just 2 quarters' time, massively outperforming the industry. In our case, contrary to that, while we have been much faster in losing our margins, but we have been extremely slow in getting that growth. So this is really, really surprising that on one side we are giving away our margins at much more pace than what we have anticipated. And when it comes to getting growth, we are like, now if you compare with past, how it has happened versus that, yes, it may be a little bit good, but then there is an industry tailwind as well. But we have not done a super normal job on the growth as well. So my worry is that, where are we heading to? Means if this business is there a fundamental problem, or how big is the problem from Cisco, or what are our internal issues? Are we into the servicing the wrong industries where margins will be low or talent crunch will be higher than the other part of the industry? I'm sure you would have brainstormed on this a lot, but it will be very helpful if you can, throw some light for us, because it is really, really an impossible kind of equation which you are giving us, that, margins will fall sharper than what we have anticipated and growth will come slower than what we have anticipated. That means even we are not fully confident of what we are doing. That is the message we get from this number. So if you can please guide us more.
Sure. First of all, good morning, Sandeep. Good to connect with you again. So let me start by saying that, and let me make a very strong reiteration that we are not clamping down on growth. Growth resilience and creating a consistent headroom for growth is ultra critical for us. Let me just step back and share some data points with you, Sandeep. When we started on this journey, our quarterly revenue was $120 million. And that is 4 quarters back. This last quarter, we gave $155.9 million. That is the magnitude of growth we have covered in 4 quarters. To give you a sense of what we have achieved, actually 5 quarters. So here is some details about 5 quarters of growth. So when we started on this journey, and Sandeep, just around the time when we published our strategic plan, post that, the first quarter of FY22, our growth was 4.8%. Second quarter of FY22, our growth was 12.3%, of which 6% was inorganic, 6.3% was organic. The following quarter, we gave growth of 4.7%. The last quarter, we gave a growth of 4.2%. And this quarter, it is 3.1%. So if you see, last 5 quarters, we have consistently delivered growth. And the last 2 quarters, we've been above median. Right? Additionally, our new logo acquisition continues to be strong. Last year, for the full year, we got 45 new logos. Last quarter, we added 9 new logos. Next interesting data point is that if you look at our dependence on top clients, exactly a year back, 38.4% of our revenue came from our top 5 clients. Now, our top 5 clients contribute 33.4%. So it will give you a sense of how our dependence on our top 5 clients has reduced. We have, in this quarter alone, Sandeep, scaled up 2 more clients in the 10 plus category. And if I go the last several quarters, you'll find the data points to be similarly favorable. The reason I go back so many quarters is, Sandeep, is to answer your question as to the journey that we have covered in the last 1 year. Now, from a margin perspective, there are 2 issues, right? First of all is that it's an industry issue, slightly exacerbated in our case, which is that attrition continues to be at a historically high levels, right? We are talking of last 12-month attrition for us at 28.1%. That is very, very sizable. And that, look, is mostly in line with what's happening in the industry and what is happening with companies of our ilk, right? For a company like us, which is about 12,000 people, that kind of attrition has an impact. That's number 1. Number 2 is, beginning of last year, we did not have a freshers program. In course of the year, we put a freshers program, a very, very strong training program and an onboarding program. The first 3 quarters, all our competitors, including us, were going after freshers. So suddenly all the freshers evaporated from the market. We could only hire about 600. And then last quarter, we added 1,300 freshers, right? Now, one of the things that competition, I think, has been able to do better than us is because of this fresher program, you are better able to handle the pyramid. In our case, we had to depend to drive you. I just shared the growth numbers with you. That kind of growth, we went, like I said, from 120 million per quarter to 155.9 million per quarter, right? That kind of growth, we had to then fulfill with lateral hiring, with subcons, and we also had to backfill for attrition. That is the reason why the margins have come down. Now we are focused on getting that back, and we see traction in the freshers program. We see green shoots. We see the deployment improve, the cost of delivery, the gross margin in the projects and clients where they've been deployed. And that is why we are confident that this improvement of pyramid will be one of the biggest levers that is going to help draw our margins back to the mid-teens that we spoke of, right? So I just wanted to share, your question was a very detailed question, and I thought I should do justice by giving you, a very elaborate and expansive answer.
No, Ajay, thanks a lot for that. Just a small follow-up, and I'm sorry I have to again, come back to that. So two things in this. So will it be fair to say, and I'm not specifying top 5, top 10, but will it be fair to say that one of our large clients, pain which we have seen, and the client itself is going through a big challenge, that pain has broadly bottomed out for us, at least if not for the client? That is part one. And is that the primary reason of our so much of problem on both margins and growth? How much of our problem you will attribute to that client, and if it is a material number, has it bottomed out? So that is half of the question. And second half of the question will be like, there is only one small concern in the way we are approaching is that right now on one side we are struggling with and obviously the industry was struggling with the manpower, so we are also struggling. But if let's say this macro worries, God forbid, comes true, and there is a hard landing of recession, hypothetically, then in that case what we will be left with will be low growth and very high cost resources, which you cannot, obviously, in our industry we don't have a pattern of letting people go off when times are tough. So we will be only dependent on natural attrition as a lever, which itself falls very sharply when macro worries come. Although I don't think that we will have a scenario like that in tech. I think people will continue to spend on tech in a very big way. So I have a strong view on the sector and cycle. But having said so, I'm saying hypothetically, if that situation arises, where both growth starts falling even for a quarter or two because of macro worries or postponement or delays, and at the same time we are left with very expensive subcontractors and resources, then our situation will even worsen. So what is our backup plan for that?
Sure. So let me two questions. Let me answer both. The first is large clients situation. So Sandeep, I'll refrain from talking about specific clients, but let's talk about top 5 clients, right? So top 5 clients for us, I just shared with you some data points, right? From Q1 FY22 to Q1 FY23, our dependence, the percentage of revenue from our top clients has fallen from 38.4 to 33.4, 5% improvement, right? Just gives us better growth resilience, number one. Number two is that in this client, and we are hyper focused on making sure that we provide absolutely top quality services to our top clients, right? Just as we would with any new client. So, there's absolutely no diminution in the quality of service we provide. What we have seen is that there's ups and downs, a little bit up, a little bit down, but no material in that group of clients, no material rise, nor a very material fall. So it'll go up a little bit, go down a little bit, but it'll stay within the range, right? So that's one. So that's to answer your first question. To your second question, yes, we are watching over the macroeconomic conditions very, very carefully, right? I had mentioned in the last earnings call that, that in the short term, there is going to be a blip, and we have seen that play out during this quarter, right? Our consumer services has been impacted, our HTM has been impacted, right? And various areas where, client spend has, reduced or postponed or deferred, or in some cases cut out already, cut out completely. Now, in terms of how that will impact our costs, so few data points. First of all is that this blip, we feel, is here to stay for maybe 2-3 quarters. I told the last couple of times, and I still maintain it, that the long-term secular growth trajectory of the industry is not changing. That long-term growth is going to continue. with inflation and Fed intervention, etc., there's going to be a cool off. It's a 2-3 quarter affair. Next thing is attrition. We believe that in the coming couple of quarters, the attrition rate is going to fall by about 5 to 7%. Right? So that is going to, ease our troubles a little bit, but it is still considerable, and it will still need backfill. And we are hoping that as we crank up our fresher engine and our junior engine, fresher and juniors, that we are able to backfill our departures with people at the lower end of the pyramid, right? We've had success in the initial deployment, and we hope to accelerate that. Outside of this, we are applying other levers as well. So pyramid lever obviously is critical to reduce cost of delivery, and cost of delivery is the reason why our gross margin went down, and then the subsequent impact on EBITDA and PAT. But also improve our utilization, continue to push the shore mix, and continue to work on commercial conversations with some select clients, continue to drive revenue levers, which means, for deeper investment in service lines that yield greater revenue, greater margins, and so on and so forth. So those are other levers, Sandeep, which I had not talked about in the previous question, the answer to the previous two questions.
Yes, thank you, Ajay. Thanks a lot, and best of luck for the current quarter, and hope all your strategies play out well. Thank you.
Thank you. Thanks, Sandeep.
Thank you. The next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks, Ajay, for the opportunity. Just the first question, can you give us a growth outlook segment-wise? How are we looking at the growth outlook in FY23? Segment-wise growth outlook in the next 3 quarters of FY23. Can you throw something, because you highlighted a couple of quarters getting impacted because of the.
I'm sorry to interrupt, Mr. Shah. Your voice is breaking. We are not able to hear you properly.
Can you hear me now?
Please proceed.
Yeah. Thanks for the opportunity. What I'm asking is, can you throw some light in terms of the growth outlook across sectors for the rest of the 3 quarters of FY23? When you said a couple of segments, including high-tech and consumer, are getting impacted because of the macro issues.
Sure. So, hey, good morning, Sandeep. So, Sandeep, if I understood your question right, let me start response. What's the impact of the macro outlook, and how are things going to look going forward? So, just a small call out is that I'll refrain from giving future guidance, but let me give you a sense of what's happening right now. So, like I had mentioned, and I had called out the previous quarter, is that there will be short-term blip because of macroeconomic conditions, right? And we have seen that play out this quarter, especially in sectors like consumer services and HTM. Clients are reassessing their spend and have been situations where they have cut down, deferred, reduced, or completely eliminated discretionary spend, right? And we think that for especially these 2 verticals, there is an impact. However, BFSI continues to do very well for us. The momentum is strong. Geography-wise, UK and South Africa, UK continues to deliver well. South Africa is back in growth. And even in the verticals that are impacted, we are winning new deals, etc. And we just have to monitor how some of these deals and the growth in other verticals and geographies offset some challenges that we have due to macroeconomic conditions in HTM and consumer services.
Thank you. The next question is from the line of Mr. Divyesh Mehta. Please go ahead.
Hello, am I audible?
No, there is a lot of disturbance, Mr. Mehta, from your line. I'm sorry.
Is it better now?
Yes, please proceed. Please be a little louder when you ask your question.
Okay. Can you share the number of freshers added this quarter, and can you share what's the full year outlook on fresher addition? How many people are we looking to add?
Divyesh, can you please repeat your question?
Okay, I'll repeat. How many freshers have we added in the current quarter, and what is the full year outlook on the number of fresher addition?
Sure. So Divyesh, let me share some numbers. In the last quarter, towards the end of the quarter, we added 1,300 freshers. We remain strongly committed to adding freshers in the forthcoming quarters. In this current quarters, we hope to add another 400 or 500 freshers. And we want to, obviously, we are going to dial it based on, business conditions in terms of how we stagger the onboarding of the people that we want to bring in. But we want this trend to continue. We have made a very significant investment in the whole fresher program. It has begun to fire, and we will continue to drive that very hard.
Okay, thanks.
Thank you. The next question is from the line of Amit Chandra from HDFC Securities. Please go ahead.
Yeah, hi. So good morning. Thanks for the opportunity. So, you mentioned about some pockets of weakness in the retail vertical. So, if you can elaborate, what kind of weakness you're seeing, in terms of, is it certain pockets or is it across clients? And also, what actually gives you the confidence that this will not accelerate to other verticals as well? And, in terms of your conversation with clients, how you're seeing, their spending plans for the next year?
Right. So Amit, hi again. And, just to reiterate, we see because of economic uncertainties, spend reduction with retail and some HTM clients. What they're doing is they are looking to curtail their expenditure in line with what they see as the economic uncertainty that is looming, right? So the first area of expenditure cut is discretionary spend, and towards that, areas such as experience, design, and actually in some cases, large transformation programs, they have either started deferring or cutting back, or in some cases, slicing up to much smaller projects. So they're doing all three, depending on how critical the program is. And we see this, from a wide swath of clients in these two sectors, right? We think as the economic uncertainty plays out, as the economic cool-off happens over the course of next couple of quarters, this is going to impact these two verticals for us. And as things start coming back under the new normal, once, especially the Feds have realized their goals of stabilizing inflation and, in effect, cooling the economy to stable levels, I think, it's very clear that the long-term prognosis for these two sectors also continues to be strong. So we just have to watch for what happens over the next 2 to 3 quarters.
Okay. And so on the margin front, you mentioned that we have scaled up the freshers hiring program, and we intend to bring the margins to mid-teens over the next 2-3 quarters. But if I see our subcon spending, it is one of the highest in the industry, and it has scaled up significantly over the last 5-6 quarters. And in terms of the on-site presence also, it has also been increasing. So is it fair to assume that the deals that we're winning are largely on-site deals wherein it is having lower margins, or we are we are planning to win deals which are more offshore from here on to bring the margins back to the mid-teens level. So how things are structuring and how we are confident to bring margins back, because these things seem to be structural, and with the macro being the concern, how we intend to scale the margins back.
Right. So, Amit, I'll answer your question in three parts. So first of all is, we are very, very strongly focused on growth, right? We want to create growth resilience and we want to create headroom for future growth. That's number one. Number two is that, look, when you're growing, and I just shared some numbers of growth, we've had quite a significant growth journey over the last 5 quarters. Now, in an environment that is so supply inelastic, you have to go hire people. Now, of course, you would want to hire all laterals. You want to hire as much of freshers that can be put into the pool. But then, there is no running away from the fact that with this kind of growth and with such inelastic industry supply situation, you will increase your subcontractor outlay. Because, we have won those projects, we have to deliver the projects, and if we can't find people and we have to go into subcons, we will have to go into those subcons. Our objective is that over a period of time, we will start rationalizing them. The third thing is revenue mix, on-site versus offshore. What we have, Amit, is it goes up and down, right? But it's largely within that range. So this quarter, we went up by, the on-site component went up by 200 basis points. Last quarter, if you remember, our on-site component went down by 125 basis points. So this will be range bound, we'll operate within the range. Some quarters it will go up a little bit, some quarters it will go down a little bit. Long term, we are putting measures in place, and that will play out over the next 3 to 4 quarters, is a very strong push towards increasing offshore business. That, obviously is always margin accretive for us. So increasingly we have to do that. But just to, assure you that this movement is not, a sudden spurt. We've been in this range for a while now.
Okay, sir. Thank you and all the best for the future.
Thanks.
Thank you. The next question is from the line of Mukul Garg from Motilal Oswal Financial Services. Please go ahead.
Hi, Ajay. Good morning.
Hi, Mukul.
Ajay.
Hi.
Ajay, I know the discussion on margin has been quite threadbare today, but so I just wanted to kind of delve a little bit deeper on parts of the commentary which you have shared. You have been talking about the supply side inelasticity impacting the profitability over last few quarters. Now, this is something which, as earlier participants also mentioned, has been industry phenomena, and I think Zensar hasn't been able to match the industry in terms of absorbing the cost. So I'm just wondering whether besides the fresher addition or the subcontractor, has there been any other factor which really has hurt us a lot more than others, whether in terms of the respective branding position as a potential employer, or in terms of the incentives we have offered in the near term to the sales guys as we kind of ventured into our journey to recover our growth, and whether those measures will start cooling off over next quarter or next few quarters, which can give us some leeway to bounce back our profitability sharper than what our industry peers are doing as we had to kind of put in more investment in the near term.
Right. So Mukul, let me answer your question in 2 parts. So first of all is that the margin situation that we've encountered has arisen because of, the key driver is on one side, fairly sizable increase in our growth trajectory. If you remember, we came out of 7-8 quarters of shrinkage, and now we've had 5 straight quarters of growth. So the growth has been quite strong, right? And then you have to fulfill talent for that growth. And we've suffered very high attrition, right? I mean, industry as a whole, and then us particularly, we have suffered a very high level of attrition, right? So these 2 reasons, these 2 factors have put a dent on our margins, and it continues to pressure, right? And how are we responding? Last year, we gave one of the biggest wage hikes in the history of the company. This year, similar levels of wage hikes, right? And then, addition to the wage hikes, we've had to make, including in the last quarter, periodic interventions to basically prevent our people from leaving, right? So attrition is a huge area of focus for us in terms of reducing attrition. And I think, steadily the kind of measures we have taken and also, with slight cool off that we see happening, right? I think our attrition numbers should start improving. Right? The second factor is, what are the levers we have used in the past for fixing this issue, right? So one is that the whole fresher program was not available to us 5 quarters back. We did not have one. We put one in place, and it's accelerating with each passing quarter. Each passing quarter we bring in more freshers, we learn new stuff of how to enable deployment, how to accelerate deployment. So it's something that we are doing consistently quarter on quarter, right? And it's not just the fresher, it's also how we manage our pyramid. We just are so focused on fixing that, starting with the freshers program. It's something that will gradually and steadily bring us back to, our mid-teens goal. Just that we now feel that we are 2 quarters delayed. Outside of this, we are working on shore mix. We are working to improve utilization. We are working aggressively to fix any leakages that may be there. We are also working on commercial levers. We are having selective commercial discussions with our clients, around rates, etc. We are also, focused on high margin service lines. So I did speak about, how advanced engineering, data and platforms are the strongest growth service lines for us. And in this also, we see some margin differentials. So our investment also is obviously in areas where, we see higher demand. And fortunately, it's areas where there is better margin. And we'll continue to also drive OPEX levers, for example, support cost of talent acquisition, etc. So there's a 360 approach we are taking towards fixing margins. And that is why we feel, we are delayed, because I think the impact this quarter was quite high. And, we've got a coming quarter with wage hikes, etc. So it's delayed a couple of quarters, but the interventions we are taking, we are confident that we'll fix it. We'll bring it back to mid-teens.
Sure. And also just one small one on growth. Again, the last few quarters have been characterized by supply constraint, which has kind of impacted our ability to grow. Now with a couple of our verticals, especially larger clients, showing some sort of slowdown, will that open up supply to target new clients and use that as a lever to compensate for the growth impact which will happen at other accounts?
So yes and yes.
Sure. Thanks for answering my questions.
Thank you.
Thanks, Mukul.
The next question is from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Yeah, hi. Thanks for giving the opportunity. Ajay, you mentioned about some of the clients are indicating a reduction in the spend. Have you spoke about the verticals specifically, and also the service areas where we are seeing this reduction in the spend? If you could throw some more light, what kind of reduction, what quantum of reduction is there on the talks? And second thing was on the attrition and wage hikes. I mean, we are seeing one of the largest. We are giving one of the largest wage hikes in the history of the company. But however, despite that, the attrition is not coming down. So I mean, just wanted to understand, how should we read this? And what are you? I mean, you mentioned steps about what are you taking, but just wanted to understand that.
Right. So 2 questions here. So let me attempt at answering both. So first of all is the quantum of reduction varies there. I can't give you specific instances, but I'll tell you that the quantum of reduction is material enough that, consumer services this quarter, constant currency reduced by 4%. After having blistering 4 quarters of growth, this quarter it reduced by 4%. And HTM barely is flat. It grew 0.6% constant currency, but just about, right? So the quantum of reduction is material enough to make impact on revenues. So that's the answer to the first question. Answer to the second question is, last year for us was a little bit of catch-up. This year, what I can share with you is that we've given one of the best hikes, and the initial response from the associates has been very positive. You think, if I may request you to chime in as to what you see with the hikes and the response and additional points that you'd like to mention. Vivek is our CHRO.
Thanks a lot, Ajay, and thanks, Mihir, for the question. Yes, Ajay, as you have mentioned, there have been multiple interventions we have taken, and wage hike has been done this quarter. So while we see that our attrition has increased slightly on LTM basis, which is very similar to industry, but we do see moderating of attrition this quarter as an outcome of these interventions we have taken. And the interventions are not only related to compensation. Obviously, we have given increased rewards and recognition, which is towards the higher side of market. But we have extensively focused on other levers. We know that it's a hybrid workplace situation, and we have focused towards ensuring that there is high level of engagement and correctness. And one important area which had led to attrition in the industry as a whole was providing growth opportunities. So we have taken initiatives like quarterly promotions, etc., and significant investment in learning to ensure that we provide growth and learning opportunities. And all of these and more has led to us see that attrition is getting stabilized. And what we think is that it will reduce in coming few months.
Sure. Thanks for the answer. And just an extension to the earlier one, and how should we see this weakness? I mean, I understand it is difficult, but for what long period of time will this weakness continue, in your opinion?
So in my opinion, Mihir, I think it is a 2 to 3 quarter affair until we hit the new baseline, right? I think what Fed is trying to do is to really work to control inflation. And with the measures that are being taken and the general state of the economy with inflation, etc., it's a very strange setup. It's a big dichotomy. I think it is 2 to 3 quarters is what we anticipate, and let's revisit this next quarter to see whether it's 2 to 3 quarters, less or more. Right now, my prognosis is 2 to 3 quarters.
Sure, yeah, that's it from my side.
Thank you. The next question is from the line of Manik Taneja from JM Financial. Please go ahead.
Yeah, I hope I'm audible.
Yes.
So thank you for the follow-up opportunity. I just do you think some of our struggle essentially is also
Mr. Taneja, I'm sorry to interrupt. Your voice is breaking.
No?
You can go ahead.
Yeah. So I just basically just wanted to get your thoughts. If our struggle essentially is also a function of the portfolio mix for us as compared to some of other tier 2 players, because you had been speaking about FY23 being or catching up with peers on growth in FY23, and statistics also suggesting same. But now you're highlighting certain concerns there, while the commentary from peers remains mixed. So is it a function of our portfolio mix that's impairing growth for us?
So Manik, hi again, and look, I can't comment on the peer group, and their portfolios, but I can, share insights into, our portfolio and our business. So the data points that I shared with you, Manik, pertains to our portfolio, our business, and, our verticals, I would say, right? And our verticals are high-tech manufacturing, consumer services, and banking, financial services, insurance. And, and then the services we provide across our five service lines in 3 geographies. So I can give you insights and all the points that I discussed through course of this call is again with respect to our portfolio, Manik. I can't really comment on, how the competitors are doing with their respective portfolios.
Sure. And just a clarification question, while on margins, you guys are now looking that we'll get back to mid-teens EBITDA margins by second quarter of FY24. How about the catch-up on growth to peers? Does that also get pushed off?
So, two different tracks, margin and growth, somewhat related, but, we are tracking the two, on two clearly different tracks. Growth for us is also a function of what we see with the economy, right? So we are seeing a blip in a couple of our verticals, and we'll have to see how that pans out the next couple of quarters, right? However, we are confident, we are sanguine that the long-term secular demand is going to continue to remain strong, positive, and stable, right? So short-term, we will see some blips, but the kind of investments we put in, the kind of momentum we have generated, the kind of teams we have brought to bear, the kind of service lines that we are driving and how well some of them are doing, I think, long-term prognosis, I'm absolutely confident. And margin, you heard the whole thing, I'll not repeat again. You heard what we are trying to do to get back to mid-teens by Q2 of FY24.
No, so Ajay, the reason why I requested for that clarification, when you came on board last year, and between January and May, when you unveiled the strategic roadmap, you had suggested a timeline of about 4 to 6 quarters for catch-up. Now we are almost 15 months from that strategic plan rollout, and thereby that's the reason I was asking, is there any timeline that you guys are suggesting with regards to the growth catch-up?
Sure. So Manik, just to repeat some data points, if you look at our last 5 quarters of growth, right? So it's exactly after we published our strategy and we got on the growth trajectory, right? At that point in time, I had mentioned it will take 4 to 8 quarters for us to get into predictable, sustainable, profitable growth, right? Now, if you see what we have achieved in the last 5 quarters, right? So in constant currency, the growth respectively has been 4.8%, 12.3%, or 6.3 plus 6, which was inorganic, 4.7, 4.2, 3.1% constant currency this quarter, right? Last quarter was 4.2%. So if you see, we have moved above the median, right? Mm-hmm. Now, having said that, we do see some softness because of economic situations impacting 2 of our verticals, right? And at least 1 service line. So, I think we are executing very strongly. And bottom line to that is our focus continues to be to create growth resilience, to create that headroom for future growth. And while we work on getting back to mid-teens by second quarter of FY24. So I think we are well on the path of execution. From the time we published the strategy to now, we've added, in constant currency, 26.3% revenues quarterly. So I think we are strongly on the execution path now. Sure. We feel quite good about the execution thus far.
Sure. Hoping to see improvement going forward. Thank you.
Sure. Thanks, Mani.
Thank you. The next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah. Thanks for the opportunity. Can you hear me?
Mr. Sachin, there is a slight disturbance in your line. Can you please increase your volume a little bit?
Yeah. Is it clear?
Yes, please proceed.
Yeah. Again, sorry to harp on the margin again, but we are currently at an EBITDA margin of 11%, and we have headwinds which you called out. There will be 2 rounds of wage hikes. Then the third quarter, we will have furloughs. And also almost 50% of your vertical portfolio, we believe there should be a slowdown in the next 2 to 3 quarters. So are we again optimistic to assume that by second quarter of next financial year, we will achieve 15%? Because that looks again slightly stretched looking at these scenarios and the headwinds, both on revenue and margin, which you are calling out.
Yeah. So, Sandeep, hi again. And if I heard your question right, just to respond, I think, previously the same question was asked, so I'll just kind of reiterate the response. Growth and margins, we are tracking on two different. They are related, somewhat related, but we are focused on tracking these on two different channels, two different tracks, right? Two different swim lanes. So margin, we are laser focused on fixing margins without impacting our thrust on growth, right? So that is on one track. And then on the growth track, we have short-term headwinds of growth related to macroeconomic conditions, tracking that very carefully. And we will see how it plays out the next 2 to 3 quarters. So I can't give you guidance into the future, but we are tracking macroeconomic difficulties and seasonal ups and downs.
Okay. Just to follow up, so in terms of second quarter, if you look at the wage hikes, and last year we called out in the second quarter the total impact of wage hikes and the delivery cost being as big as 530 basis. So in that scenario, to achieve our guidance, are we also aspiring to show a flattish kind of a margin in the second quarter, or there would be a downtick because of the wage hike in the second quarter, and then it would be full off in the second half of this financial year?
Yeah. So Sandeep, I'll request Sachin to take that question. Sachin, if you will, please.
Thanks, Ajay. So Sandeep, given that wage hikes for us are effective from 1st of July, we will have some impact on the margins in second quarter. But given the various steps, various programs which are linked to optimization of cost of delivery and linked to OPEX, we believe that part of that we may be able to offset. But we will have impact of salaries in a similar range of what we saw last year, this quarter as well.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Ajay Puthuria for closing comments.
So thank you, and thank you everyone for joining our quarterly earnings call. Really deeply appreciate and look forward to talking to you in the next quarter, and if not in the interim. Thank you very much, and good morning, good evening, good night.
Thank you. On behalf of HDFC Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your line.